right, so welcome to the September Ag Economics Dialogue. Joining us this week is one of our extension specialists, Matt Elliott. He'll be giving some grain marketing overviews. So I'm going to turn the screen over to him. I'll be monitoring the chat area. If there's any technical or clarification questions, I'll jump in if we need to keep that going. So I'm going to turn it over to Dr. Elliott. Floor is yours, sir.
All right, thank you, Matt. So yes, I'm Matthew Elliott. I'm a associate professor here at the Ness School of Management and Economics at South Dakota State University. So my primary area of interest is really in ag business, ag risk management. I do cover, the grain commodity market prices pretty thoroughly. So today I'm going to be talking just about, where we are for the 24-25 grain complex, really just corn, soybeans. I'm not going to focus on wheat and try to squeeze all those in. Corn, soybeans kind of are the real dominant ones in the complex anyways. So I will talk about that during today. I do have this slide presentation on a share note. So if you're interested in receiving the slide presentation, the best thing to do is email me and I'll give you my email at the end of the session. I do have a BPress link, but I know some people have had issues getting the presentation from that. So it might be better just to email me for the link. So just as we're looking at, we'll first start on corn and what's going on with the current corn market. Obviously, so we just had our second report from USDA about size of the crop and what yield and acres are going to be. But this particular September report, which was last week, really had those objective yield surveys where USDA personnel go out to randomly selected fields, are measuring, how many ears are in a certain square area, what's the weight of the ears and so forth. And so this is really what we get our objective yield data from in this latest report. A lot of that, what was found in that was higher yields. We do have lower acres from last year, but the higher yields is really making up for those lower acres. And as a result, it's kind of what the market's been building for into the price for over the summer months here is just this expectation of higher yields, larger supply, and that's caused futures to be trending downward. Basis is also weak interior and at the Gulf. And so that's additional price pressure that we've been seeing. So just to kind of dive into the numbers a little bit on what USDA did report for 2024. So as I mentioned, we did reduce corn planted acres this year from 94.6 million in 2023 to 90.7 million in 2024. However, we increased yield substantially from 2023 when it was 177.3 bushels per acre. Right now, USDA is expecting about 183.6 bushel per acre crop, and that's over the 181 bushel per acre they started out with at the beginning of the season. As a result, total production is up. We are looking around that same 17 billion bushel U.S. corn supply for 2024. And that's pretty much the same as last year, even with smaller acres. Even with the larger supply, so we do have larger demand, but in the end, we're still adding to the critical factor that the markets watch, which is that ending stocks, what will be left over after our demand from that supply at the end of next year. And what's that percent level? And that's the critical factor that the market really watches. And so you could have supply decrease, go up, or you could have demand increase or go down, and that'll affect that percent of ending stocks to use. And that really has an influence on price, which I'll talk about in the next slide. So currently right now, with the current demand expectations and with the current supply expectations, we are looking at basically a 13.75% ending stocks to use, which is up over 1% from 2023 that was at 12.14%, and up, almost 3 or 4% over 2022, where we saw a lot higher prices for corn when it was about 9.88%. So now just kind of turning to some of these supply and demand analysis and how they affect price. So on this graph, this is the relationship between stocks to use and the average September futures price. And so, there's a pretty good strong relationship between stocks to use, which is on the x-axis, and then the futures price of September, monthly average futures price of September, that's on the y-axis. So currently basically at this 13.75% stocks to use, we would expect around about a $4.26 futures trading price. Right now, last time I looked, September corn prices were trading about 406, so slightly below what we would expect. But, right within the range of what we would tend to expect given this current fundamental situation. Now, generally, a 1% change in ending stocks to use in either direction, whether because of changes in the supply expectations as we combine or changes in demand, you could see a 29-cent move in the opposite direction. So, for example, if we go from 13.75% back down to 12.75% stocks to use, because maybe the yields aren't as good as we get the combines in the field, we could see an increase or we would expect to see an increase in futures prices about 29 cents a bushel during the September period. Now, if we kind of look at how the December contract, which is the major new crop contract that the future market trades, so this is for December corn 24, how it kind of evolved over throughout the year. As I mentioned, fundamentally, initially we were looking at about a 90 million acre, 181 bushel per acre crop during that spring period. However, as we got into mid-June and through mid-July, the forecast and the observed weather, especially in the Central Belt region, was very favorable for higher yields. So of course, the market immediately starts pricing in those higher yield expectations as those forecasts are coming out, as we're observing that favorable weather during that key reproduction period for corn growing in the area. And so they basically reduced prices during that period of 64 cents over 15 days. And since then, we've been really trading this range of about 385 to 416 per bushel on the December contract since that period of time. And as we looked at next year's crop, so this is December corn 2025. Of course, if we were, our ending stocks to use has jumped by 1%. And so even next year's crop, it went down, or expectations for prices are going down. And so, at the beginning for December 25, we were looking at, in the 430 to 460, right now we're looking at the 430 to 460 range that you could maybe lock in prices for next year. But if we see changes of yield over the course of the season, this harvest season, get back to maybe that 180, 181 bushel per acre, we could see maybe potential for locking in corn prices around 480 bushels per acre. Maybe that $5 if there's really bad, lower yield expectations than what we have projected so far. In addition to the futures being lower, we've also seen weaker South Dakota corn basis. So in Aberdeen, currently right now we're about minus 60 cents under the futures market. At this time of year, we're typically about a minus 35 cents. At least that's been the 5-year average. So, when we see weaker interior bases, it's just kind of indicates that, the elevators and interior supplies are abundant for any local or interior demand that we are seeing. And so there's not really any concern about originating corn supply. And same thing can be said for at the Gulf. Not only are we seeing weaker interior basis, but we're seeing weaker Gulf basis at the export terminals. So typically seasonally, we would be seeing about $1.15 over, or excuse me, $1.25 over the futures price, but we're about 115. So we're just slightly maybe weaker on the Gulf basis, and that just indicates that there's plenty of corn at the export terminals to meet current export demand. You know, typically as we look at the seasonal futures price chart for corn, prices are typically the highest in that April to March and June period, about 10 to 20% above average. You know, that's when you typically have the most uncertainty about the upcoming crop in the year with planting concerns. Are they going to get enough corn planted in the ground because of weather? And just, we still have the July period that we could see very hot, dry temps that can really reduce yield. So there's a lot more risk premium in the market during that April to March or June period. And that's why we typically see 10 to 20% above your average annual price during that period of year. Obviously, during the harvest months, we're always about 5% below or 10% below, the average annual price. So if you're looking at trying to, lock in next year's crop, or even if you're trying to sell old crop here, you probably got to wait till that April, March period to see higher prices, unless something fundamentally changes, either from supply expectations or some kind of, demand event that we have not seen that would be more bullish to prices. Just a couple things on export or ethanol demand and exports. Ethanol demand has been pretty good here lately. We're seeing incremental slight changes in ethanol demand as higher blends of ethanol have started to penetrate the market and we're getting higher blends of ethanol relative to total gasoline demand, but it's a slow process. Currently, right now, we're doing about 1.05 million barrels of ethanol demand or consumption a day, and that's stronger than what it has been in previous years. On the export front, typically we export most of our corn to countries like Mexico, Colombia, Korea, Japan. China is a big unknown. Sometimes they come in and start importing U.S. corn, and then other times they just don't really do much. In the last year, they haven't really imported much U.S. corn. And so they're really the big unknown. If they did come in and start being a player in the U.S. export market, then certainly that would be bullish for export demand. Where we are for U.S. corn exports on a monthly or seasonal basis, we're about average, maybe slightly above average. And so not really seeing anything from a bearish or bullish standpoint on the export front for U.S. corn demand at this point in time. So just kind of summarize, for a market outlook at currently right now for corn, looking at that larger ending stocks, 13.75% up, over a percent from 12.14% in 23. That is causing weaker futures prices that we've seen already. That's built into the market. We have a little weaker Gulf at plus 115 cents versus 125 cents that we would see at this time of year. South Dakota corn basis is very weak, minus 60 cents versus, minus 35 cents that we've seen more recently. Ethanol demand and feeding margins are pretty good. If we can get some increased domestic demand to kind of chew through some of these stocks and reduce our ending stocks to use by the end of next year, that could certainly support prices. On the flip side, if we see weaker demand on either ethanol or exports or feeding, that would certainly cause prices to be more bearish than they already are. Corn futures is pretty much probably range bound in this price range that we're looking at until March time period. as long as the current fundamentals play out. So if USDA doesn't change their yield expectations, if they're not changing their acreage over, from the September report through the January report, and we really just would basically expect prices to stay pretty range bound, which is pretty likely. We could see higher prices if some of these yields don't materialize, but it just, it's more likely that we're going to see higher yields given the weather that we did see, and so forth. So as we look for, next year's crop in 25, we certainly don't need more than 90 million acres, but I think that we will see a shift from soybean acres to corn just because maybe the economics is better, but we really at this point in time don't need more than 90 million acres if we're going to continue to get 182 bushel per acre yields. One uncertainty item out there is still, will this Ukraine war come to a conclusion? If it did, we could see Ukraine increase in corn productions and become a larger player on the export market, which would have maybe cause us to lose some export market share if Ukraine did come back as a big, large corn producer and exporter. Turning to soybeans now, larger production, both soybean acres and yield are up. Futures has reflected that. We have larger supplies, and futures has been on a downward trend. Basis is also weak. And so that's additional price pressure. We're still continuing to expect to see over the next year and in 5 years that we're going to see reduced exports of actual raw soybeans out of the U.S. and more crush as we continue to bring new soybean crush facilities online, and we start to use more of our soybean oil for renewable diesel, biodiesel, and so forth, in order to meet some of these, the clean fuel standards that are being implemented in different regions and in Canada and so forth. And so that continues to be something that the market watches for, is that less export, more crush type of situation. So the USDA numbers in September here, we had larger planted acres in this year. So we went from 83.6 million planted soybean acres in 2023 to 87.1 planted million acres in 2024. So about not quite a 4 million acre increase, but 3.5 anyways. In addition to the acres, we've seen larger soybean yields this year because of favorable weather as well. So right now we're looking at increasing yield from 50.6 bushels per acre last year to 53.2 bushels per acre this year. And that's up above expectations of about 52 bushels per acre at the beginning of the year. So as a result, our overall supply, is a lot larger. We're looking at about a 4.9 billion bushel soybean supply in the U.S. this year, which is substantially larger than what we've seen in most recent years. 2018 we had 4.8, and that was the closest one in the last few years. So certainly larger soybean supply in the United States as we looking into this year. Certainly demand is going to be higher. USDA is projecting higher crush because of these new plants coming online and meeting that renewable market. Maybe not at the pace that we would all hope. If we could get up to maybe a 2.7 billion bushel crush from the 2.4 billion that USDA is projecting right now, that would certainly help alleviate some of these stocks and get stocks to use back into a more normal range. But currently right now, with the crush and even with the increased exports that the USDA is projecting, we're still going to end up with about 550 million bushels in soybean ending stocks, which if you take the total use or ending stocks divide by the total use, you get that 12.53%, which is up substantially over 8.27% from last year, and almost twice as much as 2022 when we had a 6.23% ending stocks to use. So certainly a lot more soybean stocks, and that's really what's pressuring prices. And again, as we can see, largely our futures prices tend to have a strong relationship with our ending stocks to use. Currently with the 12.53 projected stocks to use, we would expect September futures prices to be right around $10. Right now we're trading above that, or last I looked, we were trading about 10.13, so slightly above what we would expect, given where the stocks to use situation that we are in right now. Generally, if we have a 1% ending stocks to use change, we would see 36-cent move in futures in the opposite direction. So for example, if we went from that 12.53% down to 11.53% because of increased demand or lower yields, we would expect to see, we would go, futures prices would increase 36 cents during the September period. Now, if we kind of look at the November soybean contract of 24, the major harvest contract that the market generally trades for U.S. soybeans, and how it kind of evolved throughout the year. Again, much like the corn chart, we had higher ranges initially on there in the spring. When we were looking at the 86.5 million acres and about 52 bushels per acre. But as the acre planting period was favorable for larger acres, we started getting those larger acre reports, plus the favorable weather that increased yields. We saw the futures market take off about $2.21 a bushel over about 52 days during the market period, and priced in those new higher supply fundamentals. Right now, the new price range we're looking at is about 960 to 1050. Though we are trending a little bit on the upward now. Kind of maybe the bottoms are in on both the corn and soybean markets. If the current fundamentals don't get any worse than what they are. As we look for November 25 soybeans, so looking at pricing in next year, certainly if we can get back to the fundamentals that we were looking at in the spring, maybe we can find those $11.15 to $12 price ranges. But currently, right now, November 25 soybeans, you're looking at maybe a 10.20 to 10.90 futures price range that you can lock in. Certainly try to find opportunities around that 10.90 to sell and do some locking in. As with futures and similar to corn basis, we are seeing pretty historically weak soybean basis here in South Dakota. For example, in Aberdeen, we're about minus 75 cents under the futures market, and we're typically about minus 45 cents for this time of year. So certainly a weaker soybean basis. Just like corn, when you see weak interior basis, it just means there's sufficient soybean supplies. The elevators have plenty of stocks, crushers have plenty of stocks, and so forth. And so they're not really incentivizing, bring me stocks immediately for interior demand. Similar to the interior demand, we've seen weak Gulf basis as well in soybeans. Right now we're sitting about $1.30. Typically we'd be about $1.40 seasonally right now. And then so that it just indicates again that there's plenty of soybeans at the export terminals to meet current export demand in soybeans. So unlike corn, soybean futures doesn't really have a lot of seasonal tendencies. You don't see the best prices necessarily in the spring. A lot of that depends because our market really trades South American soybean production and weather. And then there's different export factors that come into play. But anyways, we don't really see the same seasonal tendencies. So soybeans can stay, you can still find, higher prices or lower prices throughout the year. But you probably maybe tend to more likely see higher prices, especially in the March to July period, is probably pretty typical. As we turn to looking at, where we are with crush, and exports. So the latest, NOPA, Oilseed Processors Association monthly report was pretty bad for August. And that could just be for a couple reasons, that plants are doing maintenance or certain things, and could just be an aberration. But we only were crushing about 160 million bushels of soybeans in August. Typically we're about in that 180, 175 million bushel crush on that report. And so hopefully, the September report jumps back and we get higher crush. But overall, generally, we've been seeing higher crush in the NOPA crush reports. As these new crushing plants come online, they are using their capacity to crush more and more of the soybeans. So we'll continue to watch that. For our corn markets, in countries by destination, generally China is the largest importer of U.S. Soybeans. They were this last year. Expect to see them continue to be so in the future. One maybe small surprise was Egypt was a little bit of a bigger buyer of soybeans here in the last year, and they kind of come in and out depending on where they can source soybeans in other places if they're cheaper, say from Europe and so forth, or from South America. So it was interesting to see that Egypt was a larger importer of soybeans this year from the U.S. Typically this is our lower period of year for exporting soybeans. Most of the soybean exports taken over by South America. During this period, we start picking up soybean exports in the world during that October to February period. So most of our exports do occur during that period. So we'll hopefully see, that we maintain in the average zone level. Currently, right now for this year, we're looking pretty average for what our export pace we would expect, and so that's generally what's shown in the USDA numbers. So just kind of summarize, what we're looking at for the soybean market outlook. Much larger ending stocks. We're looking at 12.853% in 24 from 8.27% in 23. So that's had that large, pressure on futures prices. Seeing definitely slightly weaker Gulf basis at plus 130 cents versus plus 140 cents typical for this year. And we're also seeing very weak South Dakota interior basis at minus 75 cents versus minus 45 cents. We can certainly see increased domestic demand to help consume some of these stocks. If we can get more of these crushing plants online, the crush margins stay positive, or we find some export demand over the season, then we can certainly see some of that increased demand, maybe help alleviate and chew through some of these additional stocks. I think on the soybean complex, especially this fall 24 election outcome will be a kind of a key. You have Donald Trump, and he's been kind of still advocating for tariffs in his economic policy. And last time we, started implementing a lot of tariffs, we had a lot of counter tariffs, and especially from China, and that really affected our soybean demand. So if we get into those types of tariff wars, that could be a problem if that's an election outcome. Alternatively, the Harris administration might be looking more to incentivize more renewable diesel type of incentives, and increasing or continuing on some of the tax incentives that are in the current legislation to help plants and try to build additional capacity and meet this new demand in the next 2-3 years. So if we see the Harris administration, for example, come in and extend some of those tax credits for renewable diesel or build upon those, that would certainly be an event that would be bullish for soybean demand and going forward. And so I think there's a lot of potential for this fall election to kind of direct, where we are going with soybean demand in the next 3, 4, 5 years. Soybean futures prices are likely range bound until we start, seeing what happens with Brazilian production. So Brazil starts planting basically at the end of September and October their soybeans. Generally, weather is watched very closely in that December, January period for yields in Brazil and Argentina. If we see any weather problems or planting problems during those periods, that would certainly be bullish for soybean futures prices in the US. And also, whatever yields we get in acres, we changes that might occur in the USDA reports could have an impact on the market. So those would tend to be, we would need to tend to watch those as those come about. I would expect some of that shift in soybean acres for this year, the 87 million planted acres, to go to corn, maybe 3-4 million. Like I said at the beginning, we don't need 3 or 4 more million in corn if we're going to get 182 bushels per acre. So, if we have that shift, that's going to weigh in on corn unless we see lower yields. But I do expect to see some soybean acres shift unless we see some demand changes and higher soybean prices going into next year. And so that should help reduce soybean stocks, but that might add a problem more in corn stocks. Last, I just want to talk about, so we have been developing over the last 5-6 years, real-time platforms to take in producer precision ag data, keep it up to date with real-time yield estimates, and then take in real-time market data in order to understand real-time value at risk of producers, what they're currently looking at, what are potential opportunities, what's price probability, and so forth, and trying to find market opportunities for producers. And because these are often the market opportunities are very short-lived. Fundamentals can change really fast, as I showed in those price charts. The fundamentals on corn yield changed within 15 days. Fundamentals on soybeans changed within 50 days in the trading market. So you have to be very proactive as a marketer. And so what we try to do with the precision ag data and the real-time market data is to make producers alert to those changes when they're occurring, and to be able to act fast and mitigate any type of negative risk to their margins. And as we look forward, expenses really are not going down, but prices have been going down, which is going to really squeeze margins for our soybean and corn producers going forward. So we do have a partner with JD Operations currently and Climate Field View. We have partnered with New Vision Cooperative in Minnesota. So if you're interested in a demo in our Agrivar, or just check out our website, you can just go agrivar.ag and see what we're doing. But this is kind of Agrivar kind of grew out of research and things we were doing at South Dakota State that we're kind of bringing to a commercial startup in the region. So with that, again, I'm Matthew Elliott. My email, matthew.elliott@sdstate.edu, is right here. If you want this, the presentation itself, please email me. I will send you the link to get the presentation. Or if you have questions, then let me know. I can also answer questions. So with that, that's what I have for right now. I'll turn it back over to Matt Dearson. Unless there are questions.
Yeah, you don't get to turn it over to me. We are still recording, so you've had some corn and soybean outlook here. We have a large number of participants active. If you want to use the chat or unmute yourself, you could ask a question directly at this time. While we're waiting for anybody else to trickle in, just a clarification question, Matt, with your seasonality charts on both corn and soybeans, was that were those charts the nearby or new crop for
This
the
is
seasonality?
This is the continuous, so it's the spot month front.
Okay, so it's the rolling.
Yeah,
the rolling, so,
rolling
okay.
spot month.
Just clarification, because we try to make a clear distinction of that between things. And what are you seeing with fertilizer prices? You mentioned those at the end there too.
Yeah, so I mean, what I've looked at, this has been maybe a couple weeks old, but last time I looked, I think fertilizer prices are still staying pretty strong. Haven't seen any real decrease on that. That's why we're really seeing some, margins probably going to be squeezed with lower, output prices and higher input prices, especially on the fertilizer side. I think that if we see lower corn acres, maybe you could get some pressure on fertilizer next spring. But at this point in time, just not seeing it not on the futures level or the wholesale level, not seeing it at the retail level either.
All right. Any questions from our audience? They are a quiet bunch. So I have a question here. Were you going to discuss land rents? I think that's for you, sir.
Uh, not today. We are going to not me, but my colleagues um will be discussing land rents here next month at our South Dakota Land and Lending Conference. I'm not sure if they're scheduled on the Economic Dialogues. Han is the one that's
I
doing
don't
the
think
land
so. So,
rent
yeah.
survey. So she generally is the one that covers that.
Any other questions? All right. Matt, if you'd unshare your screen, I'm going to briefly share a general website. And Matt, will you confirm you can see my webpage?
Yeah, yes, I
All right.
can.
So, just as part of a routine sort of highlight here, and this will address the land value indirectly. This is our extension, the extension website or the SDSU extension homepage. And if you'd follow along with me here, I'm just going to highlight the agriculture and scroll down to ag business. I want to draw your attention to a couple of different things we have. So here's our experts or staff here right now. Here's a link to the dialogues and such. And then here in the middle under featured resources, the top featured resource we have here are the South Dakota Ag Land Market Trends. So that's got both the rental rates and land values from the survey, and that's been written and put together by Juan Lee. And then next to that, we've got some cattle basis numbers and such. And then down here in the middle, we do have a fair number of spreadsheet tools that are available. So I'll click on the risk calculator down here. This spreadsheet is just a combination of futures, crop insurance levels, things like loan rates and expected basis levels that you'd have on insurance. And you could download that. You have to download that spreadsheet, but then you can do changes specific to your operation. For example, if you wanted to, just to see what happens. So currently we've got the winter wheat crop insurance deadline is at the end of September, so you can make some adjustments, decisions based on current loan rates, futures prices, insurance levels, and such for that crop year. Other spreadsheets would be other budgets, crop budgets, livestock budgets, grain storage calculator, which is kind of fun to look at this time of year with both the wide basis at harvest, and then there's actually been an increase in carry in the soybean market, so that's looking maybe a little bit better than it was before. And then as we adjust these spreadsheets, we'll hopefully get those up there for you to take a look at. One other thing I'd draw your attention to is I'm one of several authors. There's, I think, 8 different authors right now that every week we put out an In the Cattle Markets commentary or a current look at the markets for across the United States. So that link is there and takes you to just a fairly short article every week and a synopsis of the markets. With that, I'm going to stop sharing